Let me start with a confession. Every year, I tempted to do the same thing you have probably tempted to do. Open a chart, pick a target, and say, okay, this is where the market will hand. It feels comforting, it feels clean, it feels like control. But this year is not a clean year in my view. It's a year when the story can change in a week. One headline about tariffs, one inflation print, one central bank sentence, one big tech earnings report, and suddenly everyone is rewriting the future. So in this episode, I'm going to do something different, guys. I'm going to talk you to the way I would love to talk a friends who invests and wants clarity, not complexity. I will share the most important ideas I'm taking into this year based on three big institutional outlets from Citibank, UBS, and JP Morgan, for example. I will keep it simple. I will keep it human. And yes, I will use numbers because numbers stop us from drifting into fantasy. And most importantly, in my view, I will tell you what I think this means for you and for all of us as an investor. Good morning, everyone. I am Alessandro. I am the founder of Macro Mornings, a global community investor, which we are more than 53,000 investors globally. We are at the top 1% of investing newsletter out there, where I share my insights, my analysis, and deep dive, uh, peeking, peeking into the financial markets. And I help you, people like you, investors like you, to understand better the markets before anyone else. You can find the link in the description. You can join today, right now, with the link in the description. And we are here to learn how to invest, to analyze all of the macroeconomic scenario. So what I would like to start this episode is about how the market doesn't care about our forecasters. See the show, a perfect example of the 2025, all right? At the start of that year, the median Wall Street forecast for the S&P 500, of course, was 6,600 points. Then tariffs headlines hit in April, and forecasters got cut down to 5,900 points. And after markets proved stronger than expected, led mainly by tech, forecasters moved again. Think about that for a moment. In just a few months, the future moved from 6,600 to 5,900 and back into a new story. So when someone asked me, where will the S&P end this year? My honest answer is, I don't know, and neither do they. What I can do and what I believe you can do too is build a portfolio that doesn't require perfect prediction, all right? Because if you need to be right about the exact year and number to succeed, you are basically betting your financial future on a guessing game. And in this year, I'm focusing less on prediction and more on preparation. Now, the world is slowing, is changing, but in my view, it's not breaking. And let's talk about the economy because everything starts there. If you listen to the news into the last year, you wouldn't thought that the economy, the global economy, was constantly one step away from collapse. But the data tells a more balanced story. Citi highlighted something I found definitely useful. A global supply chain stress measure that tracks disrupted shipping containers. Sorry, all right. And into the last year, it averaged around 1.8 million TEUs that basically account of big shipping containers being delayed. The peak in the earlier supply chain chaos period was about 2.2 million. And before COVID, normally was closer to 0.3 million. So yes, stress was still high compared to the old world, but despite that, the global growth didn't fall off a cliff. Citi estimated global real growth around 2.6% in the first three quarters of the last year versus 2.8% into 2024. Slower? Yes. A, a recession wave? Not really, in my view. JP Morgan PMI numbers, so price manager index, so a survey that often signals whether business activity is growing or shrinking, hover around 50.5 late into the last year. If you're new to PMI, think of 50 as the borderline. Above 50 suggested expansion. Below 50 suggests contraction. So 50.5 is basically saying the world is moving forward, but not fast. All right. So this is why my base case for the 26 is simple. It's a bumpy growth year, not an automatic recession year. And that matters because your portfolio decisions should start from the base case, not from the loudest tweet. Okay. And why companies are still holding the economy up? I think corporate health. Economies usually break when companies are stressed, when profits fall hard, when cash runs low, when debt becomes heavy, and when layoffs become contagious. CD pointed out that profitability in major developed economies was still holding up. G7 non-financial corporate profitability was up 5% year over year in Q2 2025 compared to an average around 3.5% in 23-24. They also show something that I like because it's very visual. US corporate liquidity relative to short-term liabilities around 93%. So companies had a lot of cash-like resources compared to what they own soon. Now, I'm not going to say everything is perfect. I'm saying the foundation has cracked, and that changes how I interpret volatility. If profits are stable and companies have cash buffer, then a market drop is often a reset in prices, not the beginning of the end. This is why when markets get scary into this year, I will be asking a simple question. Did fundamental change or did the mood change? Because mood changes every week. Fundamentals don't. And then we have the interest rates. Some easing, some waiting, plenty of surprises. So let's talk about interest rates because I know many of you watch the Fed the way people watch football scores. Okay. So Citi's view is that the rate cuts from the last year will show their effects with a lag into this year. That's a reasonable point. Monetary policy doesn't eat the economy instantly. It takes time. And Citibank also highlights a big risk. The Fed might pause early in 26 if growth stays resilient and inflation remains sticky. That would disappoint investors who are positioned for fast and steady cuts. And JP Morgan inflation numbers show why this is not simple. In late 25, inflation looked very different depending on where you lived, around 3.3%, for example, in the UK, 2% more or less in the Eurozone, almost 3% in Japan, and just 0.7% in China. That's a big divergence. Yes, you're definitely right. It means central banks won't all act the same way at the same time with the same confidence. I'm not building my strategy on a smooth rate cuts equals easy money story. I'm building it on uncertainty. Cuts may come, but the path will be debated, messy, and emotional. That's exactly the kind of environment where simple diversification works better than dramatic all-in bets. So let me be honest about what drives returns, which I think is one of the most important things for the future, especially for this year. We have to talk about something that makes many investors uh, uncomfortable: concentration. If you don't believe mega cap tech can perform, it's hard to be bullish on the US market because tech is basically a huge part of that engine. They estimate mega cap tech and communication services are about 40% of the S&P 500 market cap and about 53% of the expected 26 earnings growth. Okay. JP Morgan sector charts tells a similar story in a simpler way. Technology is roughly 35% of the entire S&P 500, bigger than financials at 13% and communication services at 11%. So when you hear someone say, I'm bullish on the market but bearish on tech, remember what that implies. You're basically saying you want the car to go fast while betting against the engine. And Citi even give us a shrinking number. If that doesn't lead, the other sector would need an average return around 17% just to produce a 10% index return. That's possible, of course, but it's not the most likely path. So over the last 10 years, Citi found zero instances where the S&P 500 was up 10% year over year at month end, while tech underperformed the rest of the market. This is extraordinarily important. That doesn't mean tech always wins. It means the modern index is built differently than it used to be. So my approach this year is not tech is invincible, but instead my approach is tech is structural, of course. So I treat it like a core risk factor I manage carefully, not emotionally. And then we have, of course, artificial intelligence, where I think the opportunity is real and so are the expectations. Let's talk about artificial intelligence because it's impossible to avoid. UBS offers a framework I genuinely like because it keeps you grounded. They say evaluate artificial intelligence through three lenses: investments, visibility, and monetization. On investments, UBS expects global AI spending, in other terms, CapEx, capital expenditures, to reach around $570 billion just in 26, roughly 40% higher than the year before. That's not small, that's a real wave of money. On feasibility, the big constraint is power. UBS points out data center electricity consumption around 180 DWH in 24 and potentially above 250 in 26. They also note that data centers are still under 5% of total US electricity usage. But, the growth rate could become a bottleneck. On monetization, UBS estimates the US AI solutions market around $74 billion today and roughly $100 billion in 26, while still being a tiny piece of what they see as a potential $3 trillion market by 2030. So, yes, real spending, real adoption, and real runaway. But UBS also explains why bubble talk shows up. Some valuations look extreme. They even mention cases where AI companies were valued at $400 million to $1.2 billion per employee, and they point to huge valuation debates around major AI players. They also compare valuations in public markets. The Magnificent Seven price to earnings ratio is just around 28 times versus about almost 20 times for the rest of the S&P 500. So in my view, guys, AI might be the next big wave, of course, as we have said many times into this podcast, but the market has already priced in a lot of hope. So the team stays strong, but the ride is volatile. Strong earnings can push prices higher fast. One disappointment can hit prices hard, and UBS gives a historical anchor that helps me and should help us to stay calm. AI investment is around 1.3% of in the entire GDP, similar to the telecom boom of the 1990s, and far smaller than the old railroad boom in the 1880s. In other words, AI is big, but it's not automatically the entire economy yet. So I'm not treating AI as a lottery ticket. I'm treating it as a long cycle with moments of hype and moments of fear. So right now, let's talk about real life. A lot of sentiment can be gloomy, even when spending stays strong. We have the consumers, we have the jobs, and the spending side. And what is important around all of this stuff? Inflation psychology, inflation expectation. For years, people perceived inflation around 2-3%. Into the last year, the perception jumped to 5-6%, partially linked to tariffs. So even inflation comes down slowly, the memory of high prices stays in people's mind longer. And UBS shares with us a statistic I want you to remember because it changes how you interpret headlines. The top 10% of incomes drive more than 50% of consumer spending. I wanted to repeat it, listen very well. The top 10% of incomes drive more than 50% of consumer spending. So when you read the consumer is strong, you should ask yourself, which consumer are we talking about? Okay. And JP Morgan showed unemployment rate around 4.6% and wage growth at around 3.9%. That's not a picture of collapse. And UBS points out weak spots too, like younger workers, unemployment for ages from 20 to 24, around 9%. So I'm not panicking because hiring slows. I start working if unemployment rises meaningfully and stays high, because that's when spending can break. And then we have China and Asia, of course, in the emerging markets generally, but where growth is there. But property still casts a shadow. China data is clean and useful. The GDP growth out there was around 5.2% year over year. Earlier in 25, it slowed to about almost 5% by the Q3. That's still growth, but it's cooling. The bigger issue remains property. Housing inventory data shows around 36 months of inventory in an 80 city survey. Tier 1 cities were about 24 months, Tier 2 about almost 32 months and Cairo 3 for 15 months. That's heavy. And it explains why China's confidence cycles can be fragile. Property takes time to help. For me and for us as investors, that means Asia can offer opportunity, but I don't treat it like a simple it will bounce story. I treat it like a region where you need sizing, passions, and a clear reason to own it. And now for ending this phenomenal episode, guys, let me bring this at your home person to person. I'm not trying to be the smartest person in the room. I'm trying to be the calmest. That's different. I'm reminding myself that even professionals got whiplash into the last year. 6,600 forecasters became 5,900 and then got revised and revised again. The story will shift this year too. I'm also using a simple portfolio idea, and all of these one I think are going to harness the opportunity and are going to preserve the capital in this macro environment. Most of all, if tech drives about a third of the index, I don't ignore tech, I manage it. If AI capex is heading toward almost $600 billion, I don't dismiss AI. I respect the cycle and the valuation. If inflation is 3.3% in one place and 0.7% in another place, I don't expect a single clean policy pact. And finally, if unemployment is around 4.6%, I don't call it for recessionary every time the market has a bad week, but I stay alert for labor market deterioration. This is not about being fearless, it's about being prepared. All right. So I think this year will reward a very specific kind of investor, the one who can stay present without becoming reactive, because the noise will be constant. Every month will have a new reason to panic or chase. And if you follow every reason, you will end the year exhausted and probably underperforming. So, if this kind of macro storytelling, guys, speaks to you, I'm sure you are going to love my newsletter, Macro Mornings. It's read by over 53,000 investors each week, people who want more than noise. They want clarity, insights, and strategy. And it's completely free. So you will find the link in the description. Click the link in the description to subscribe today and join us. I wish you a great day and bye bye.